morning and welcome to today's 5 with Fitz. Futures were mixed this morning when I took to the air for an early appearance with the very savvy Maria Bartiromo on the Fox Business Network for the Word on Wall Street. Then they fell slightly after the ADP report. This is normal behavior anytime the markets are flirting with new highs, but especially now that Delta variant fears are rising and geopolitics are getting more complicated. Here's my playbook. Point number 1. Jamie Dimon doesn't want to buy 10-year bonds unless he's forced to. JP Morgan CEO Jamie Dimon does not want to buy bonds any more than I do at the moment, according to remarks he made during an interview with Maria Bartiromo. Rates are so low and the Fed is so involved that it'll be a one-way trip right into the dustbin for anybody who buys bonds at these levels. This is because bond prices fall as rates rise, and we all know that's coming when the Fed ultimately busts a move. Now, normally rates would be a lot higher in a growing economy. The fact that they're not points out a major disconnect between the real economy and the financially engineered one. Anyway, Maria asked me for my take on Dimon's remarks earlier. You can watch it now by clicking somewhere up here. Point number 2. The real risk in upcoming jobs reports is not the numbers. Wall Street would have you believe otherwise. They're waiting with bated breath for this Friday's jobs report. Analysts are fighting over this number or that number. Thing is, the numbers actually don't matter. Perception does, on the other hand. It's a classic Keynesian beauty contest. There could be a short, sharp sell-off if traders think the number is strong enough to make the Fed move earlier. A bad number, conversely, means more Fed follies that will, in turn, keep the rally on track. Now, I'm personally leaning towards the latter based on this morning's ADP numbers, which came in at 330,000 versus expectations at 653, because they are frequently a preview of the national BLS numbers due Friday. Having a few put options on hand or a small slice of your money in an inverse fund makes sense. Stay away from the leverage stuff unless you have the requisite risk management skills, however. Having these things on hand will help you stay in the fight. Point number 3, Amazon is under attack, and here's what you should do about it. The super savvy Stuart Varney does not hold back, and that's one of the things I love about him. You will know exactly what he's thinking, and importantly, why. Yesterday, Stuart noted that Amazon was under attack by socialists like AOC and Elizabeth Warren who are trying to take down the tech giant. Now, I personally happen to agree with that. What the left and anti-business proponents fail to grasp, though, is that any breakup is actually going to unlock more value for shareholders. Having at least a few shares tucked away somewhere makes tremendous sense to me. Even one will do it. Shares are, not coincidentally, well below 52-week highs at the moment. Brokerage fees, by the way, are near zero now, and there are fractional shares available, which makes it easier than ever to buy expensive stocks that you couldn't otherwise touch, even if you don't have a lot of money to invest. Point number 4, J&J vaccine recipients can get supplemental Pfizer or Moderna doses in San Francisco. Now, I said, give me 2 of everything in reference to which vaccine I wanted a year ago and suggested that mixing and matching may be required as COVID-19 mutates. Boy, and my lips are mutating today. Physicians are apparently now increasingly in agreement, which is why the San Francisco Department of Public Health and Zuckerberg San Francisco General Hospital, boy, that's a mouthful, recently said they're both allowing patients who receive the J&J vaccine to receive a supplemental dose of mRNA-based vaccines from Pfizer and or Moderna. My money is still on Pfizer. Point number 5, GM skids despite blowout earnings, and here's why. General Motors reported a beat on profits this morning and raised full-year guidance to a midpoint of $12.5 billion. Now, you think that'd be great, but the problem is this. Wall Street thinks the company is good for about $14 billion. No surprise, shares fell in overnight markets, then bounced back. Now, I'd rather own Ford and have a few speculative call options in play. Today's bottom line. The real danger facing most investors is one they don't see coming. Contrary to what a lot of folks think right now, there is no shortage of profit potential, just a shortage of people not thinking big enough. Oh, and by the way, I'm super excited. It's issue week, and you know what that means. I'm super excited to share the August issue of One Bar Ahead with subscribers this Friday. This month, we've got 2 stellar stocks, count them up, 1 and 2, that can protect your profits even in the face of accelerating inflation, a deep dive into a new trillion-dollar industry we're calling DOS, Diagnosis as a Service, and more. Please join me if you can, or if you'd find it helpful. Grab your share or somebody else will. You got this, I promise. Make it a great day. I'm Keith Fitz-Gerald, and we'll see you next time. Thank you for watching today's Morning 5 with Fitz. Click subscribe to get daily market notes right here on YouTube, or sign up for the email versions at the link below. You can also find me on Twitter and Instagram for my real-time thoughts on markets, analysis, and more.